The broadcast is now starting. All attendees are in listen-only mode.
Welcome all the Coleman's and, well, it's not really Coleman's, it's Scott Gabehart's webinar with the new SOP effective August 1, 2023. A policy and allowance of partial interest financing on business acquisitions. Scott, I've known you for a number of years. You are, when it comes to this topic, you are the expert. You've been doing this for, we'll just say a number of years, but you've close to 400 SBA appraisals just for SBA loans. I got to read this off. A certified business appraiser, a certified valuation analyst, a business certified appraiser. I know you have an MBA from Thunderbird University, which is University of Arizona.
Arizona State University.
I apologize for my friends in Arizona. I know I just committed a huge faux pas. I accept my apology. But
no problem.
Great school. He's written some books on Amazon. Take advantage of that. Anyway, Scott, it's great to have you. Okay, enough about you. Let's get into the topic.
All right.
Let's start with the poll question. See, Joseph, when I say, there you go. On a scale of 1 to 5, how serious is your bank or your lending institution considering partial interest business acquisition financing? Scott, why do you ask this question?
Well, because it is truly a novel development in the history of SBA and SBA guaranteed change of ownership loans. And I think it can be quite significant due to the wide variety of situations that involve partial interest, minority interest.
So half over half, it's half and half. Half are very, or at least, you're on this webinar because you're interested in that. Scott, I don't know if you're going to touch on this in the webinar, but why did this come about? Are you going to touch about that later? Or you want to address that real quick?
Well, I don't know precisely.
Neither do I. That's what I'm asking. I don't know.
Yeah, I don't know what the impetus was, but I think if you look at the collective force of all the changes that have come forth in SOP 5010-7, it's pretty clear that the goal was to encourage lending.
Yeah, great.
And the question is, at what risk, ultimately?
Let's ask the second question, Joseph. Overall, what percentage of SBA 7 loans are for business acquisition? Joseph, what is it? 23%, 24%?
Yeah, 23% is what we've reported in the past. And
yeah, but it's well, I've seen some up to a third. So the answer is it is significant. It is a product niche that lenders need to learn to take advantage. I shouldn't say take advantage, to become proficient in underwriting these loans. There is a lot of opportunity there. Business acquisition, you have an established business, which is good, and you have people who want to carry it on for a second generation or someone coming and buying it. So this is a very timely topic, and as we age, more and more of these opportunities are going to be available to lenders, and it's a great product. With that, Scott, I'm going to stop talking, and I'm going to let you take it over and tell us what we need to know.
Okay. Well, thank you very much, Bob. It's good to be back with you. It's been a while. As Bob mentioned, I've been involved in the SBA realm for many years now, in earnest beginning around 2001, but probably the most significant involvement that I had was during the time frame of 2008 and 9, when there was, for the first time, significant attention paid to business valuation as opposed to real estate appraisals. And I had the great opportunity to participate in helping to write the business valuation requirements and come up with the list of qualified sources and those related topics. So it's something that I've been involved with for many years now. And as most of you already know, the new SOP 5010-7 is a represents a major shift in policy as it pertains to government guaranteed loans, 7A and 504 programs. So today I'm going to walk you through just a little bit of historical perspective on the SOP with a clear end game of getting to a discussion on partial interest financing, or what would ultimately involve the valuation of minority interests, non-controlling interests. Just some stats for perspective, and I think the most significant fact here, I believe, is that the great majority of loans are under $500,000, which, as it turns out, is now the new threshold, after which the more stringent underwriting requirements kick in. So the new SOP will allow for a larger number of internally processed SBA loans. Okay, great. Now, I think most of you are aware of the history of SOP 5010 documents. I became most involved around 2008 and 9, as I mentioned, when the SOP 5010-5A was instituted. And as you can see there, over time, we went through B, C, D to K, and then SOP 5010-6, and now finally we're at SOP 5010-7. And just for perspective, the term business valuation, I believe, was referenced like 14 times in SOP 5010-5A, whereas the most current SOP references business valuation 139 times. So there's been a definite shift in the focus on government guaranteed business loans, including change of ownership loans. So back at that time, when they first decided to take the business change of ownership loans and valuation seriously, they included some concepts that have kind of permeated since then, including the fact that they consider a change of ownership to be a new business, and the loan documentation would include a business valuation, a site visit, and a real estate appraisal if relevant. Over time, of course, additional verbiage has been inserted that helps to clarify the business valuation requirements. So we go to the next slide. So some of the key thoughts, the 5010-5A required an analysis as to how the change of ownership will benefit the business, not the buyer or the seller. So there's some important perspective. It's to sustain businesses, not necessarily to help buyers or sellers. And at that time, there was a big controversy as to whether or not goodwill could be financed. And the reality is that virtually every small private owner-operated business has a substantial amount of intangible asset value. That's just the way it is. I think on average, it's something like 60%, 70%. Some industries, it's as high as 90% or more, collectively referred to as goodwill, but that could include trade name, customer base, covenant not to compete, etc. So they initially limited goodwill, but there was a lot of backlash, and ultimately that goodwill stipulation was required. This is also when they first brought up the concept of a qualified source. And at that time, it included specifically CPAs along with the other valuation organization designations. And that has changed to date, where now a CPA doing business valuations will most commonly also be an ABV, accredited in business valuation. I can't see the last line there. Specifically prohibited use of appraisal. Okay, yeah. So another key development was the fact that the lender has to request the appraisal. So a buyer or a seller can't come to the table with their own valuation from their own quote guide. Now, from experience, I can tell you that if a lender or a buyer or a seller is working with an appraiser and he or she is qualified, the lender will often entertain using that particular individual, possibly due to expertise in a particular niche. Next slide, please. So here's kind of a bigger picture perspective as to how the SBA is thinking about business valuations. Determining the value of a business is the key component to an analysis of any loan application for a change of ownership. An accurate business valuation is required because it will result in new debt unrelated to business operations and potentially the creation of intangible assets. It assists the buyer in making a determination that the seller's asking price is supported by a quote unquote qualified source. So the lender must request the appraiser must be qualified and perform the appraisal in accordance with their professional standards, and most often in accordance with the USPAP, Uniform Standards of Professional Appraisal Practice, and the business valuation requirements therein. Next, please. And here we are again to the point that the lender must request the job, and the scope of work should identify the nature of the transaction. In general, buyers or sellers, when transacting a business, can either do a quote unquote asset sale or a stock sale, and they're very different. And the point is that the valuation that's being performed must match up cleanly and fully with the transaction as it's planned. So an asset sale value is based on the value of the inventory, fixed assets, and the goodwill. Whereas a stock purchase, stock value, is the value of all the assets and all the liabilities, known and unknown. So they're very different bundles of rights. So you wouldn't want to value the stock if you were involved in an asset sale. So apples to apples is important. The valuation must include the conclusion of value, which, by the way, is ultimately and always an opinion. It's simply an opinion. It's an opinion based on facts, generally accepted valuation principles, but ultimately an opinion that's filled with assumptions, oftentimes layers of assumptions, which is why, generally speaking, if you hired 5 professional appraisers, provided them with the same fact pattern, you would end up with an array of outcomes. And on average, it could look something like somewhere between 1.75 million and 2.25 million, with a mean of 2 million. So that plus or minus 10 to 15% is almost a given due to the nature of business valuation. And again, the buyer or seller can't provide the valuation. Next. So here's the qualified source list, which, as you can see, does not include CPA. So they basically eliminated the CPA, but most CPAs who are active in business valuation have one or more of these other accreditations. Next, please. Okay, so along comes SOP 5010-7, effective August of this year, and without a doubt, the number and magnitude of changes made in this new SLP is unique and much greater in scope than any other prior attempt at updating the SLP. One of the key changes, as I mentioned earlier, is that the loan amount that does not require an independent appraisal has been raised from $350,000 to $500,000. So if the loan is under $500,000, lenders follow the process that they use internally to verify financial information for similarly sized non-SBA guaranteed loans. And given that the majority of SBA loans are under $500,000, this would appear to be a significant change. We can move ahead now. So, as I mentioned, many changes. Personal liquidity rules have basically been removed, which seems to imply that anybody with $1 billion of cash in their bank could potentially qualify for an SBA loan. Now, the credit elsewhere test, I think, will always have to be addressed, but it is an interesting maneuver to take out these personal liquidity rules. They also now are allowing that the buyer's down payment can be based entirely on a seller carryback note. Okay, that's quite aggressive. What this means is that the 10% quote unquote down payment by a buyer could be in the form of an IOU to the seller, whereas before it was limited to being half of the down payment. Now, just because the change is allowed doesn't mean that lenders are going to follow it. That this would seem to me to be a very aggressive maneuver. In other words, 100% financing, and we know what that could lead to. The amounts contributed to the down payment can remain on standby for only 24 months versus over the entire life of the loan. Another big change is that the sellers are now allowed to remain employed as a key employee indefinitely, whereas previously there was a 12-month cap, and that became a significant issue when there were cases where the company's operation was dependent on special licensing that was attributed to an individual, oftentimes the seller. So this could be helpful for these types of firms, but it also changes the landscape dramatically. The determination of affiliation has been altered, basically making it easier for what might have been considered an affiliate before to partake in the loans. And the SBA removed, well, let's go to the next slide. They removed the moratorium on the SBLCs, which basically is potentially allowing the entry of what we have come to know as fintech companies or algorithm-based lending. And that's not necessarily sitting well with all constituents who are looking at these new changes. They have also changed the underwriting guidelines to underwrite SBA loans in the same manner in which they underwrite their similarly sized non-SBA loans, as I mentioned earlier. Character determinations have been eliminated, and this is interesting. They've removed the prohibition on loan proceeds for religious activities. So to the next slide. So My focus today, or at least the end point of the conversation, is this partial interest financing. Historically, all of the change of ownership loans have been based on a complete change of ownership, where the control owner changed in every acquisition loan that was made. And what that meant was that you could not make a loan for a company to purchase back 10% of the shares to give to an employee as part of some compensation plan. You couldn't finance a 10% interest that related to the principal, business owner's estate or gift tax planning. Whereas effective August 23, these partial interests will now be financeable. And that obviously brings up the question as to how will that change the valuation process, because it is absolutely the case that a 10% ownership interest in a business is not worth 10% of the marketable control value. So the traditional business valuation performed for complete change of ownership loans is a control value. It's the value of the entire business at what we call a marketable control level of value. But that 10% interest is not worth 10% of the control value due to what we call discounts. Discounts for lack of control and the discount for lack of marketability, DLOC, DLOM. And the end result of these discounts is that typically a 10% interest is worth maybe 6% of that control value. So discounts are significant. And there's no indication as to if or how or when these discounts should be applied. It's the SOP as it stands has simply opened the door to partial interest financing. Now, if you just assume the obvious, so to speak, it will now be up to the lender working with the appraiser to determine what the proper scope of work is. And should that scope of work include the evaluation of discounts? And the reality is that that can be a very complex calculation or consideration that, if done properly, takes a significant amount of time and effort, including the review of all operating documents, articles of incorporation, corporate bylaws, buy-sell agreements, whatever the individual entity type is. All of those documents need to be reviewed in order to properly determine what those discounts are, if in fact they are required. So this is a to be determined issue, but in terms of valuation theory, it's an absolute fact that a minority interest is not worth the same pro rata share of the control value. Next slide, please. And here's the actual introduction of the concept, page 98. Changes of ownership other than complete changes of ownership or complete partner buyouts, collectively a partial change of ownership. Loan proceeds may be used to fund the purchase of a portion of one or more owners' interest in the business or of the business itself. So it's opening the door to these minority interest transactions. Both the business and the owner that is acquiring that minority interest must be co-borrowers. The small business is redeeming the partial ownership interest from one or more owners, and as a result, all of the remaining owners are also subject to the requirements for guarantees. that will have to be played out in processing these partial interest transactions. And as I mentioned before, the seller may stay on as an owner, officer, director, stockholder, key employee, or just a regular employee. So you can have these small side deals, so to speak, and without anybody actually leaving the business. Next slide. If a short transitional period is needed to assist the business, the small business may contract with the seller as a consultant for a period not to exceed 12 months. Okay, so now this seems a little bit contradictory to me. If a transitional period is needed, the business can contract with the seller as a consultant not to exceed 12 months. But at the same time, the seller may stay on as an owner, officer, or director when one or more of the current owners is selling less than their entire percentage, or they're retaining a portion of the interest, or if the purchaser is an ESOP. So this would appear to actually limit the ability of the owner, of the seller, to stay on board when selling a minority interest, as opposed to the sale of the complete business, where now the owner can stay involved as an employee or a director or whatever. So that's an interesting consideration. Next slide. So to understand this concept of discounts, you need to understand what are called levels of value. There are types of value, like asset sale value, stock value. There are standards of value, like fair market value, strategic value, investment value, fair value. But there are also levels of value. And historically, traditionally, they applied both of these discounts together and called it a minority interest discount. That doesn't happen any longer, and the modus operandi today is to apply these two different discounts separately but multiplicatively, which means you apply the discount for lack of control first, and then you apply the discount for lack of marketability against the then reduced value from the discount for lack of control. Next slide. So, levels of value, we start at the top with the marketable control value, which is typically what the SBA change of ownership loans have revolved around, the 100% controlling interest value of the entire business. But when it comes to a minority, or also called non-controlling interest, we have to be concerned with these discounts. And the next level of value under the marketable control value is the marketable non-controlling value. It's non-controlling after the application of this discount for lack of control. So generally speaking, and we'll look at the specific factors momentarily, but in general, a discount for lack of control applies because a 10% shareholder or LLC member or even partner lacks the same degree of control that's associated with marketable control value. And after the discount for lack of control is applied, then the discount for lack of marketability is applied, with the end result being a level of value that is called non-marketable non-controlling, or non-marketable minority interest value. So that's where we go from the 100% to the 60% in terms of relative values per share. So a marketable control value for a share that's $100 might only be $55 after applying the discounts. Next slide. Here are just some definitions to reflect upon. The discount for lack of control reflects the decreased value of shares that do not convey control of the closely held corporation. And the discount for lack of marketability reflects the fact that there is no ready market for selling minority interests in a closely held corporation. So it's more difficult to sell a 10% interest than to sell the entire company for a number of reasons, including oftentimes just the outright prohibition of selling to a third party in the buy-sell agreement. So a minority non-controlling interest is an interest less than 50% of the voting stakes. And I think you get the idea of what the discounts are. So let's go to the next slide and talk about, well, let's look at an example before we discuss the factors that affect these discounts. So if the business as a whole, and importantly, it has to be the stock value, the equity value, because generally speaking, you can't sell 10% of the assets. Technically, it's possible, but generally speaking, when you're talking about partial interest, you're talking about the equity value, the value of all the assets minus the value of all the liabilities, basically, known or unknown. So we start with this $1 million marketable control equity value for the entire company. And if there's 100 total shares, each share is worth $10,000 at a marketable control level of value. We first apply the DLOC, discount for lack of control. That brings at 20%, which is somewhat typical, maybe on the lower end, of $2,000 to get to that next level of value, which is the marketable non-controlling value or marketable minority value of $8,000 per share. And then finally, we apply the discount for lack of marketability, which is typically higher than the discount for lack of control. Not always, but typically. We apply that to reach the final level of value, which is most relevant for assessing a minority or partial interest. The non-marketable, non-controlling value per share is $6,000. So 40% less than the marketable control value. Next slide. So what are the primary factors that affect the discount for lack of control? Well, you can start by just discussing what are the prerogatives of control, what are the benefits of control. If you own 51% of the shares, you can elect directors or appoint management. You can set levels of compensation and other perks. You can determine if and how much dividends and or distributions are. You can direct company policies and strategy. You can buy or sell assets, liquidate assets, and generally determine when and how the company is sold. So there are clear benefits of control. So if you do not have control, therefore, your interest is worth less. So what are some of the specific factors that impact the discount for lack of control? The percent of ownership. So all other things equal, the smaller the interest, the less control. So a 49% interest, theoretically, would be worth more than a 1% interest. But that 1% interest might be very valuable if it happened to be a swing vote. So let's say you had two shareholders with 49.5% and one shareholder with 1%. That 1% shareholder has the ability to block activities they don't like and or support the ones that they do. So that 1% interest in that very unique situation has significant value and arguably maybe no discount or lack of control. How active is the minority shareholder in day-to-day operations? If you happen to be a key employee, you may have more control than if you were not. Is that 10% interest voting shares or non-voting shares, which is quite common in many companies. And surprisingly, the difference between voting and non-voting shares in terms of value, as accepted by the courts and generally recognized by appraisers, is only 5 to 7%. But that's all other things equal. If the only difference is one share can vote, one share can't vote, the difference is about 7%. Next slide, please. So turning to the second discount, the discount for lack of marketability, minority interests are affected by the value of minority interests are impacted by voting rights, the percent of payout of profits and the consistency of those distributions over time, the expected holding period, and then a whole slew of potential contractual regulatory restrictions. So, for example, with voting rights, let's look at the second one, the percent and consistency of distributions. If the company organizational, operational documents mandate that the board declare a dividends or distribution that's sufficient to pay the minority shareholders' tax burden from year to year for whatever profits are reported, that is a plus that would serve to decrease whatever discount for lack of marketability there might be. So the lack of marketability revolves around not just the relative challenge of selling a minority interest, but also the ability to convert that interest into cash and or to get cash out of the business to pay taxes on the profits that are recognized over time. The expected holding period can affect the discount for lack of marketability. The one general argument is the longer the holding period, the more risks there are, and the discount for lack of marketability is higher. But you can really get into the weeds on that one, and there's a lot of points and counterpoints, et cetera. But some of the more obvious things that affect the discount for lack of marketability stem from the review of the operating documents. Articles of incorporation, operating agreement, buy-sell agreement, and then just to complicate things a little more, on occasion state laws can override even what's in these operating and buy-sell agreements. Put rights or the right to sell a certain number of shares at a certain price is something that's valuable and reduces the discount for lack of marketability. On the other hand, if there's a prohibition of transfer to a third party, including things like a right of first refusal by the other shareholders and or by the company itself, those prohibitions increase the discount for lack of marketability. And many times, just the mere existence of a right of first refusal is enough to prevent any shareholder from even trying to sell a minority interest. Stock restriction agreement, preemptive rights, our preemptive rights are a positive thing. That generally means that if the company issues more shares, the existing shareholders have the right to acquire the same percentage interest of the new shares. So that would be a positive in terms of marketability. Forced sale through drag along rights of the majority owner. If, as a minority owner, you are forced to sell, if and when the majority owner sells, you don't have control over marketability, or there is a greater discount for lack of marketability. And there are many methodologies, approaches, market data that can be used to build up and support these discounts for lack of control and lack of marketability. And that brings me to an interesting point related to the company that I work for now called BizEquity. BizEquity is an online business valuation tool that's used by many household name financial companies, TD Bank, Morgan Stanley, Guardian, PayPal, Equifax. It's a long list. Right now our tool generates only a 100% controlling interest value, but even prior to the SOP 5010-7 issuance, we were already working on a discount calculator, which would take the user through a list of factors that are answered, which would help to craft a relevant, reasonable discount for lack of control and discount for lack of marketability. You have to have some mechanism for assessing these discounts. And in terms of the SBA world, that will ultimately, I believe, be up to the feedback and conversations between lenders and the SBA. But one option would be some sort of calculator that addresses the key factors, but won't cost an arm and a leg to develop. And the reality again is that if you formally develop a discount for lack of control and discount for lack of marketability, it can be quite time consuming and costly, and that's not generally consistent with the SBA realm, where we want to keep appraisal costs down to encourage the loans and support the small business economy. Next slide, please. So what are some of the open questions that I have is I want to make sure that this $500,000 threshold applies to change of ownership loans. I believe that it does, but I would like to have that clarified, and also to just make sure that a $500,000 partial interest transaction could be processed through the non-formal process, the under $500,000 internal bank approval process, where they could do their own valuation and potentially use a calculator like what we're developing, for example. Does the requirement for a certified appraisal stand if there's been a partial change in ownership within the prior 36 months? So as we move along and things start to happen, one of the current requirements for a formal appraisal is if the business itself had been sold within the prior 3 years. So it doesn't specifically state that an appraisal is required if there was a partial change in ownership within the previous 3 years. So I think there's going to be a number of questions like this that emerge and will require the attention of the SBA. If there's a close relationship between the buyer and seller of a partial interest, is an independent appraisal required for loans under 500? Because again, elsewhere in the SOP, there's a requirement that if the buyer and seller are related parties, a formal independent third party appraisal is required. And it would stand to reason that even if it's a partial interest transaction between related parties, that an appraisal might make a lot of sense. Next slide. This is just a list of some of the documents that correspond to the onslaught of new rules and regulations. And I've also included, or I believe Joe and Bob will include, a white paper that I prepared, which includes these and additional commentary as to these major changes to this 5010 program. Next slide. So I'm going to just read this first paragraph because I think it's important and nicely summarizes where we are right now. Many of these changes are still being debated, leading to what NAGLE President Wilkerson described as a bare minimum approach to lending standards, which increases overall risk exposure and could be devastating to the SBA's programs and the essential role in providing capital to small business owners. Meaning, almost all of these changes move to the side of more generous standards, more ease of lending, greater loan amounts, loans available in more situations without more personal liquidity, or et cetera, et cetera. And as Wilkerson said, this is problematic, particularly when it's believed that the SBA is understaffed overall. The Small Business Committee in the House, Chairman Roger Williams, is actively reviewing and discussing these changes as well. And so I'm sure there'll be additional feedback and encouragement or discouragement from this committee as well as from NAGLE. But no doubt, one of the most significant changes ever is this first-time allowance of partial or minority interest financing. And as I mentioned, there are many instances when partial interests are bought and sold. And just the mere presence of this financing, I believe, will encourage these types of transactions for many different reasons. And, you know, at the end of the day, the bank has the final say on whether or not they want to pursue this. But within reason, I think it's clear that this is a potential profit niche and that it should be pursued, but carefully, diligently. And Bob, that's my story, and I'm sticking with it.
Good job, Scott. We're going to get Bob on. I just wanted to let the audience know that this is the white paper.
There I am.
This is the white paper that's attached. We are going to get the recording, the white paper, and the slides out to everyone after this is rendered. So sit there for that.
Hey, Scott, I did want to ask you one question. I was shocked at that number you said. Really, a minority shareholder without voting rights is only takes a 5 to 7% ding on their stock. Can you expand on that a little bit more, please?
Well, it's definitely in all other things equal proposition, and it goes to the notion that all other things equal, even if you're not voting, you're still sharing in profits and growth in the company, such that the main difference I believe revolves around what you're considering in your mind, the obvious cost of having a non-voting share versus a voting share, but it's based on publicly traded stock data where they evaluate companies that have both voting and non-voting shares.
I guess let me rephrase the question. In the event of a business breakup, of a divorce among the partners, it's nasty. What happens to the valuation overall? Not only the minority shareholders, but the majority of shareholders. Does that just kill the business? And more importantly, when the lenders, when all of a sudden they have a minority partner or someone they're going to kick out, what should a lender be aware of?
Okay, a lot of things there. Well, anytime there's turmoil among the partners, that's not a good thing. And
let me write that down. Turmoil equals.
Yeah, whether or not that has an impact on the current value of the business is debatable and would be up to the appraiser to assess. Maybe the bickering's been ongoing and it has had a documentable effect somehow. But what your second question was about lenders?
Okay. What happens when you're presented and you're servicing a 7A loan and all of a sudden you find out that there's discord among the partners and this thing may blow up? What should the lender do? That's truly the question.
Good. Yeah, that is a good question and might require a psychologist to answer.
You know what? No, you're absolutely right. You're right.
Yeah. Yeah, that's a tough one, and you know, I mean, blank happens. We all know that, and it's a potential case for these partial interest financings will relate to just that, the desire of a partner to get rid of the other partners. But presumably, the transaction can be processed just as a business deal, and if the partners are bickering and not happy with one another, there's not a whole lot, in my opinion, that a lender can do other than help them to part.
Yeah, and I would also, the lender certainly has a hammer on that, saying, hey, you guys need to work this out, or we have measures at our disposal to protect our interest. And I would make that message loud and clear that, hey, we're going to go seize our assets and close you down if you guys give us any problems. You're not making payments.
Exactly. Yeah.
And that may force a sale of the minority shareholder, may prod that, or it could also get them to work together until they could sell the whole thing. But the lender, I guess I'm saying, do not stand by and watch them fight. You have a significant role in this in terms of protecting your asset, which is the loan. That's what I'm saying.
Yeah, I agree with that completely. Yeah.
Good. All right. Excellent stuff, Scott. Hey, we are streaming this on YouTube. You can view that. Please take that link. Joseph, do we have any? I don't see any other questions here.
We're clear.
Scott says, thank you for the presentation, Scott. Oh,
yeah.
Someone else says thank you for this. We'll give it to Scott. Anyway, go ahead.
Can I say one thing real quick?
Sure. Your webinar, go.
I would love to answer any questions that anybody has, and maybe online was not the way to handle it. So feel free to reach out to me at my email address, skbart@bizequity.com. I have a number of supporting documents that I could provide as they relate to minority interest valuation, which you may be interested in looking at. But I think it's a real bank opportunity that should be pursued.
Absolutely, and I think I agree with you 100%. It is difficult lending, but hey, that's the business you're in. You're to understand complicated scenarios and present a package that's good for the borrower and protects the bank. It makes a good asset for the bank. Absolutely.
Yeah.
Don't worry about if you have trouble with Scott, if you forget who he is, just shoot us an email, Joseph, and I'll be more than happy to forward it to him. Hey, Scott, open invitation, please. I want you to join our show every Monday and Friday. Let's have you on every now and then to answer some questions and bring us more of it, because this is a fascinating subject. It is significant for SBA lenders, and the more knowledge we gain about this, the better off everyone is. So, Scott,
Definitely.
thank you very much.
Thank you.
And this concludes today's webinar. Thank you.
Okay, goodbye.